Hi everyone, this is Ted Bauman, editor of the Bauman Letter from Banyan Hill Publishing. Can ancient history teach us useful things about playing the stock market? Absolutely. Consider a battle that happened in the year 2016 BC. This was a battle between Carthaginians and Romans. The Carthaginians were led by a general named Hannibal. Now, Hannibal was one of the most influential military tacticians in history, and the reason was because he learned that if you can tempt your enemy to follow you in what your enemy thinks is a retreat, you can actually encircle him and crush him. And that's exactly what Hannibal did to the Romans. Hannibal's army encircled the Romans, who moved forward thinking that they were beating the Carthaginians. But in fact, the Romans lost 70,000 legionnaires that day. Now, what's this got to do with the stock market? Well, now we've basically seen a very significant rebound in the stock market in the beginning of 2019. Things were really looking pretty dicey right about Christmas time last year, but all of a sudden things have popped back up again. And the most convincing explanation for this is that the Federal Reserve, under Chairman Jerome Powell, has announced that it's not going to pursue interest rate increases during 2019. The market had thought that there would be at least two, perhaps even more this year, but the news that the interest rates were not going to go up seems to have got everybody back into buying assets. Now, why would they do that? Well, one reason is because when interest rates are low, it makes relative yields in the stock market, even fairly small ones, a better choice of investment. It also lowers the cost of capital for companies, which increases their earnings and profits, and makes them also more attractive for stock investors. But the problem is that if you look at the last 10 years, the period since about 2010, what we've seen is that there's been a pretty consistent increase in earnings for companies. Leave out the interest rate part of it and just look at what's been happening with earnings. Well, essentially earnings have increased pretty much quarter by quarter for most of the period. There was a dip during 2015 and 16, but particularly last year, earnings really had a very good run. What we're seeing now, though, is that earnings are starting to suffer a bit. Quite a few companies have reported lower earnings year on year than they did at this time last year. When a company's earnings are lower, in other words, the growth rate of their earnings is lower than it was in a previous quarter, that makes many people think the economy might be slowing down. And I think it is. And here's why. When the Federal Reserve started to try to goose the economy after the 2008-2009 financial crisis, essentially it held interest rates as low as possible. That allowed companies to make investments at practically no cost. But at the same time, during this 10-year period, there's been quite a significant move towards offshoring. In other words, moving production in U.S. plants to foreign countries like China, like Mexico, like Southeast Asia, etc. Now, what that means is that the two biggest factors in the cost structure of any company in the United States, interest rates on their borrowings and labor, were essentially cost-free, or the costs were not rising. So as the economy recovered, earnings went up every quarter. And every time earnings went up, profits went up because costs were not rising along with earnings. I think we've reached the end of that period. I think we've reached a situation where the cost to companies of conducting business is going to start to rise. But remember, interest rates are only one of the factors of cost. Things like labor costs. Labor costs are starting to creep up. It's been taking a long time, but they are starting to creep up. The US dollar is exceptionally strong. That is raising the cost of imports, particularly of machinery and raw materials used by American companies. And finally, uncertainty about Brexit and uncertainty about the Chinese economy mean that foreign trading and global trade is uncertain, and it may actually end up rising or raising the cost to American companies. Now, if that happens, then there's no fundamental reason why American stocks should continue to go up, right? If companies, even if they continue to report higher earnings, their profits may not go up because their costs are finally starting to rise along with their earnings. And that's where my analogy to the Battle of Cannae in 2016 BC comes in. Just as Hannibal and his Carthaginians retreated before the Romans and tempted them to follow them into disaster, I think the Federal Reserve may be doing something similar. By keeping interest rates low right now, even though the Federal Reserve is not required to do so to prop up the stock market, it's been taken as a signal by investors that everything's going to be fine, that the low interest rate punch bowl is going to remain at the party. But that means that investors piling into stocks these days, certain types of stocks, may end up being trapped, because if the economy does start to generate higher costs for business, that means even if earnings are rising, profits may fall. And if profits fall, that means stock prices have to fall. So beware of following the interest rate trap. It could be a dangerous one. This is Ted Bauman signing off. Thank you.